Hey everyone, Daniel here from Next Level Life, and today we're doing a video that I wasn't planning on doing this week, but I made a mistake. And as soon as I realized that I had made a mistake, I wanted to make sure that I cleared it up so that you guys can have the accurate information and to hopefully head off some questions that might otherwise have been raised on future videos. Those of you who have been around the channel for a while might have seen my asset allocation and investment strategy series. I've been uploading videos once a month or so, examining a different asset allocation or investing strategy from a bunch of different angles, like how strong its returns have been from as far back in history as I can find complete and reliable data on, to what the volatility and investing experience has been like, and even how well the strategy handles itself in terms of achieving and maintaining financial independence. And it's in that last section that I made a mistake. In the accumulation section of the financial independence segment of 4 of the videos in the series, the figures for how often the strategy historically reached financial independence and how long it took to get there are incorrect. Those 4 videos are the all-stock strategy, the classic 60-40 strategy, the no-brainer strategy, and the Merriman ultimate buy and hold strategy. After double-checking the spreadsheet and rerunning the simulations, it seems that the other financial independence figures, such as the minimum and perpetual withdrawal rates that I talk about in those videos, as well as the return and crash figures mentioned, are still accurate. So to the best of my knowledge, it's only these financial independence accumulation figures that are off. I've also left a note to myself in the spreadsheet to ensure that I don't make this mistake again in future videos, and have left pinned comments on each of the already uploaded videos in question with the corrected figures, so if someone watching it doesn't see this video, they'll at least be able to get the corrected figures there. The reason the accumulation figures for those videos are incorrect is because I forgot to update the target 30-year minimum safe withdrawal rate for those 4 allocations before running the accumulation simulation in the spreadsheet. As a result, the spreadsheet was still using the unique safe withdrawal rate for the permanent portfolio, which was 3.15%, to calculate the level of wealth that an investor would need to have accumulated by any given time to determine if financial independence had been reached. Obviously, the other allocations had different 30-year minimum safe withdrawal rates based on their own historical returns, volatility, and how far back the data went on them. So today we'll be talking about a few things. I'm going to be going over why this error makes a difference in those accumulation metrics and why I feel it's worth utilizing the unique safe withdrawal rates for each strategy, even though it is possible to switch strategies once you've reached financial independence and are looking to enter the drawdown phase. And as a result, rendering the FI savings goal equal regardless of the strategy you used while you were building your nest egg, and of course, rendering this particular error inconsequential. We'll also be going over the corrected accumulation metrics for these 4 strategies. And then we'll be wrapping up with some interesting lessons that I've learned after discovering and correcting for this error. Because once all the figures were corrected, a couple of interesting patterns became clearer that weren't as easily seen before, and I think they're worth discussing. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. So first things first. Why does this error make a difference? Well, there's a couple of reasons. The main one is the effect of the targeted safe withdrawal rate on how much money someone needs to be considered financially independent. If someone's wanting to reach financial independence on, say, a $40,000 a year lifestyle, and they have a target safe withdrawal rate of 4% based on the asset allocation they're using, then they would need at least a $1 million nest egg to be considered financially independent. This is because their initial 4% withdrawal from that nest egg would be $40,000. And from there, of course, they could adjust their withdrawals to keep pace with inflation each year. However, if that same person was utilizing an investing strategy that could only support a 3% safe withdrawal rate, which is not too far off of what we saw with the permanent portfolio, then they would need a nest egg valued at nearly $1.334 million before settling down. If, on the other hand, they used a strategy that would allow for a very high safe withdrawal rate, say 6%, then they'd only need half that, or around $667,000. Assuming relatively equal savings rates, you can imagine how much easier it is for someone to amass $700,000 compared to nearly $1.4 million, even if that someone gave up a little bit of overall returns to do so. And you can imagine how much quicker it can be done. And given that not all strategies we've covered in this series and are going to cover in this series are aiming to accomplish the same things, and not all of them have data going all the way back to, say, the Great Depression, which does tend to drag down those minimum safe withdrawal rate figures, it should come as no surprise that there is a fair bit of variation in those figures. Heck, we haven't even really gotten into the strategies that are really trying to maximize those withdrawal rates yet, and we're still seeing near 6% rates from some of the strategies that don't have data going quite as far back to the Great Depression. The other reason this error makes a difference is that we don't have a whole ton of data points to look at. Granted, the 90-some years we have to look back on the metrics for something like an all-stock or classic 60/40 strategy is enough to get a good idea of the history. But when you start looking into these strategies that only have complete data going back to 1970 or 1976 or even the 1980s, then barring some incredible returns, which again is not the primary goal of every strategy, that aren't brought down by simultaneously high levels of inflation, as did happen to many of these strategies in the 1970s and early 1980s, you just don't have that many unique starting dates that will give you enough time to build that $1 million nest egg or whatever it is, especially if you're using relatively lower savings rates like the standard 15% that we use in the first example of every video. So yeah, it makes a difference, and while you could choose to look at all the strategies on equal footing during the accumulation phase and then decide to switch strategies to whichever one provides you with the best safe withdrawal rate once you reach whatever level of savings you want to have when you settle down, and therefore basically getting the best of both worlds, which is, to be fair, basically what the series has been doing to this point, even though that was not my intention when I started out, I don't personally want to look at it that way for a couple of reasons. The first is that depending on how your investments are set up, there could be some very costly tax implications if you decided to switch up your entire allocation right before reaching financial independence. And the second is that if you're aiming for financial independence, then you're probably thinking long term. I mean, unless you have an astonishingly high savings rate, we're probably talking north of a decade, if not a couple. Given that, I think it's important to choose an asset allocation that you'll be comfortable with during those years so that you don't shoot yourself in the foot during one of those inevitable stressful stretches that all strategies eventually have. So with that being said, let's look at the corrected accumulation figures for the all-stock, classic 60/40, no-brainer, and Merriman Ultimate strategies. The all-stock strategy, represented entirely by a large-cap blended index fund like the S&P 500, had a 30-year minimum safe withdrawal rate of 3.48% between 1927 and 2019. That's up from the 3.15% we saw in the permanent portfolio. After running the simulation, we find that the all-stock strategy would have reached financial independence in 23 out of a possible 93 scenarios, assuming a savings rate of 15%. As those savings rates rise, so does the frequency of reaching financial independence. At the 30, 50, and 70% rates, the all-stock strategy succeeds in 59, 76, and 86 of the scenarios respectively. The classic 60/40 strategy had a 30-year safe withdrawal rate of 3.98%. Using this new target and the same savings rate assumptions, it would have reached FI in 5, 35, 75, and 86 of the 93 possible scenarios from 1927 to 2019. That's up from the 1, 26, 69, and 84 successes that we saw when using that lower permanent portfolio target withdrawal rate. I only had data on some of the assets used in the no-brainer strategy going back to 1970, so there weren't as many scenarios to test, but of the 50 that I could look at, I found that it had a 30-year safe withdrawal rate of 4.79%. Based on that, it wouldn't have reached FI yet using a 15% savings rate, but it would have reached it in 10, 34, and 43 of the 50 scenarios with a 30, 50, and 70% savings rate respectively. That again improves upon the results we saw when using the permanent portfolio's safe withdrawal rate by a sizable amount. Under those original circumstances, it would have only reached FI 25 times using a 50% savings rate and 40 times using a 70% savings rate. Previously, it hadn't actually reached FI in any of the available scenarios with a 15 or 30% savings rate. The Merriman Ultimate strategy, or at least the modified version of it that we had to use for the video due to my not having data on international small cap value funds, had complete data going back to 1976, and a safe withdrawal rate during that stretch of 5.88%. Similar to the no-brainer strategy, it has yet to reach FI utilizing a 15% savings rate, but under a 30, 50, and 70% rate, it succeeded in 16, 32, and 39 of the 44 possible scenarios. Compare this to the all-stock strategy during those same years, and we see that the Merriman approach actually comes out ahead with these updated targets, which is great to see given how much the strategy puts into equities. Since 1976, the all-stock strategy has reached FI in 10, 27, and 37 of the 44 scenarios using a 30, 50, and 70% savings rate respectively. Just like the Merriman, it has yet to reach FI utilizing a 15% savings rate under the assumptions we've been using in this series. On average, it would take the all-stock strategy 63 years to reach FI with a 15% savings rate, 42 years at 30%, 22 years at 50%, and 12 years at 70%. Its fastest success with a 15% savings rate was 35 years, starting in either 1930 or 1931. At 30%, it was 24 years in 1942. At 50%, it was 12 years in 1948, and at 70%, it was 6 years, again, in either 1930 or 1931. Its slowest path with a 15% savings rate took 79 years. That started in 1939. With a 30, 50, and 70% savings rate, those figures dropped to 59 years, starting in either 1958 or 59, 42 years starting in 1954, and 26 years starting in 1961, respectively. The classic 60-40 strategy took 88, 59, 24, and 11 years to reach FI on average using those same savings rates. Interestingly, all 5 successes at the 15% savings rate took either 88 or 89 years. So, at its fastest, the 15% savings rate took 88 years in either 1927 or 1930, and at 30, 50, and 70%, it took 32 years starting in 1927, 28, or 1930, 13 years starting in 1927, and 6 years starting in 1930 or 1931, respectively. At its slowest, it took 89 years in 1928, 29, or 31 at 15%, and 75 years starting in 1939 with a 30% savings rate. It took 42 years in 1954 at 50%, and 24 years in 1962 at 70%. The no-brainer approach took 41, 20, and 9 years on average at the 30, 50, and 70% savings rates. At its fastest, it took 36 years in 1982 at 30%, 15 years in 1984 or 1985 at 50%, and 7 years at 70%, anywhere from 1980 to 83, 1990 to 1993, 2007 or 2008, or 2011. At its slowest, it took 46 years starting in 1954 at 15%, 27 years starting in 1970 at 30%, and 16 years again starting in 1970 at 70%. The Merriman Ultimate approach took 27, 14, and 6 years on average at the 30, 50, and 70% rates. At its fastest, it took 23 years in 1984 at 30%, 12 years in 1982, 1995, or 2008 at 50%, and 5 years at 70% anywhere from 1982 to 85 or 2002. At its slowest, it took 31 years starting in 1987 at 15%, 17 years in 96 at 30%, and 10 years in 1976 at 70%. So those are the corrected figures, and as I said earlier, once I got the chance to see those figures, some interesting patterns started to become clearer. There were 2 that I felt are particularly relevant for the series. The first was the clear tendency for the gap between the success frequency of each asset allocation to shrink as the savings rate increased. With a 15% savings rate, the all-stock strategy led the pack, reaching FI in roughly 25% of all scenarios. The classic 60-40 strategy was the only other one to reach it at all, with a 5% success rate. At a 30% savings rate, with the exception of the permanent portfolio, we see that each strategy did at least have some successes. The all-stock strategy still leads the way with a 63% success rate, but the classic 60-40, Merriman, and no-brainer strategies are picking up steam, with success rates of 38, 36, and 20% respectively. By the time we reach a 50% savings rate, the majority of that initial gap is closed. The all-stock strategy succeeds at reaching FI in 82% of all available scenarios. Trailing it are the classic 60-40 and Merriman strategies at 81% and 73%, and bringing up the rear are the no-brainer strategy and the permanent portfolio with success rates of 68 and 57% respectively. And at the 70% savings rate, the successes look almost identical, with the all-stock, classic 60-40, Merriman Ultimate, permanent portfolio, and no-brainer strategy posting success rates of 92%, 92%, 89%, 88%, and 86% respectively. Now that may seem like an obvious pattern because of course if you're saving more of your income, you'd naturally build up a nest egg quicker and therefore would probably reach your savings goal more frequently. But I do think it is still worth noting because when you're able to reach those lofty savings rates, either through generating a strong income, thoroughly optimizing your budget, or some combination of the two, your choice of investments almost ceases to matter, at least for the purposes of reaching FI. There is still going to be some difference in the average amount of time it takes to get there if you're utilizing a strategy with comparatively lower and or more volatile returns. The second was the tendency for the longest time to FI results to come during or shortly preceding periods of high inflation, such as the 1970s or early 1980s, or the early and late 1940s. There was also a tendency for the shortest time to FI results to come in just before or during extended bear markets, such as the Great Depression, the oil crisis of the 1970s, the downturns of the early 1980s, 1990s, or 2000s, and of course, the Great Recession. The all-stock strategy's slowest starts were 1939, 1958 and 59, 1954, and 1961 at the 15, 30, 50, and 70% savings rates respectively. In 1939, the market was just about to experience a few down years that would then be followed by a couple of years of high inflation in the early 1940s, and then again later in the decade, so it was difficult to get traction in real terms, especially given that they were using a comparatively lower savings rate. The mid to late 1950s and early 1960s were a bit of an interesting time to see come up. While the first half of the 1950s was incredibly strong from a return perspective, and inflation wasn't out of control in either decade, illustrated by the fact that we actually have two start years from the 1940s ranking as the fastest starting years for this strategy, it is also placed in a spot in history that isn't ideal for a different reason. Given the savings rate that we were using, the strategy would be nearly reaching financial independence right as the market downturns and high inflation in the 1970s and 1980s began to kick in. Therefore, what might have looked like a really solid run by the late 1960s ended up turning into a longer process as the downturns wreaked havoc on the value of a very large nest egg at the time, and the high inflation took its toll on what was by then already an elevated spending level. The classic 60-40 strategy had a similar story, posting its slowest runs for the higher savings rates in 1939, 1954, and 1962 for similar reasons. The slowest run for the 15% savings rate did technically come before the Great Depression, but as all 5 of the successful runs using that savings rate took either 88 or 89 years to complete, that isn't saying much. The permanent portfolio had its slowest runs in 1933, 1938, and 1965, which is not too dissimilar. The no-brainer and Merriman strategies, of course, didn't have data before 1970, but we do see the same patterns playing out. All 3 of the no-brainer's slowest runs came in the first half of the 1970s, meaning that it experienced the majority of those high inflation years right off the bat. And the Merriman strategy experienced its slowest runs in 1987, 1996, and 1976. The 1976 run obviously had to deal with that inflation, without getting the benefit of investing a large sum of money when the market was down in the first half of the 1970s, while the runs in 1987 and 1996 both preceded extended bear markets, but not before having a significant amount of time to build up their nest egg, as opposed to starting their journey right before or during the downturn, which, given their higher savings rates, would have probably sped up the process quite significantly. For instance, 2 of the 4 fastest scenarios for the all-stock strategy came during the Great Depression. All 4 of them came during or just before that stretch for the classic 60-40 strategy, and 1 of the 2 did for the permanent portfolio as well, with the other one being the 50% savings rate scenario, which posted its best start in 1992. It took 28 years to finish though, so it'll be interesting to see if as the years go by, we see that best starting years start to creep closer and closer to the start of the 2000s. As for the no-brainer and Merriman strategies, we saw 2 of the 3 fastest scenarios starting during the downturn of the early 1980s. There were also equally fast starts during the downturn of the early 1990s and the depths of the Great Recession. For the Merriman, we also saw a really good mark posted during the depths of the dot-com crash. So while it isn't an absolute rule, the pattern is pretty clear, and it is fairly consistent. From the perspective of reaching financial independence, market downturns, especially early on, are a great opportunity for us to blitz our way through the process, especially if we're investing a large portion of our income into the market when it's on sale. And the greatest enemy of our financial independence success is not necessarily market downturns, even the troublesome ones that come later in the process, but rather it's our own personal spending inflation rate. In other words, lifestyle creep. And just to give you an idea of how much of a difference it makes, let's assume that someone investing in the permanent portfolio for no other reason than it probably had the weakest overall accumulation metrics of the strategies we've covered so far in the series, and let's assume that they managed to optimize their budget well enough that they wiped out the effects of inflation on their spending. They didn't go quite as far as to lower their annual expenses in inflation-adjusted terms, but they did keep them steady. What would the accumulation metrics look like then? Well, assuming the safe withdrawal rates were the same, in this case a 30-year rate of 3.15% for the permanent portfolio, then it would have achieved FI in 58, 70, 79, and 86 of the 93 possible scenarios using a 15, 30, 50, and 70% savings rate respectively. On average, it would have taken 33 years, 24 years, 15 years, and 8 years to do so. Its fastest path at each savings rate was 27 years, 18 years, 10 years, and 6 years. At its slowest, it took 46 years, 30 years, 18 years, and 10 years, again using those same rates. Compare that to the version where expenses increased in line with inflation, and you can see how much of a monumental difference it makes. And that was with probably, again, the weakest of these 5 strategies in this particular group of metrics. So I know this was a really long-winded way of saying I made a mistake and I'm sorry, but I am. And I hope you can forgive me for that and for having to push back my regular videos this week to clear things up, but I do hope that it did clear things up and that you got something out of it. I also hope that you guys enjoyed your holiday. I look forward to getting back to my regular uploading schedule and the next part in the asset allocation series again starting next week. I'll talk to you then.